Hey, thank you so much for joining me. I'm Mitch Goldberg. This is my live stream with your post-market show all about personal finance, investing, overall, helping you take control of your money so you can make smarter financial decisions. And right now, it's important to make smarter financial decisions because when things are emotional and people are, let's say, afraid, worried, downright scared shitless, we need to have a personal check-in and make sure that you are not just acting on that you're not just acting on emotion, that you are carefully considering all of your moves. Dow plunges today, major averages plunge, S&P as well, Nasdaq as well. Continuation that started last Thursday, accelerated Friday, and hit today. Last week we were talking about this. Last couple of weeks, a few weeks ago, I said I think we're in a recession. And we've been talking about how the stock market is doing a lot worse than what the major averages have been showing. Well, not anymore. The major averages are not hiding cracks anymore. They are the cracks. And things are just cracking wide open right now. We're going to talk about why, what, maybe a little bit of what to do next. I think you need to know about that too. But so many things to talk about today. These are important things. So let's just roll the introduction. We're going to have a really good show. Now, if you have any questions, please ask me in the comments. I love hearing from you. It's the best part of what we do. And your questions are important. If you have a question, it means somebody else could have the same exact question. And that would be great. Of course, words of wisdom, words of encouragement are always appreciated as well. And while you're watching, give us a thumbs up, a heart, an applause, celebrate reaction, whatever it is, a care, just so I know you're out there and it helps spread the good word about the work that I am doing here for you and I can help others. And now we shall roll the intro. Here we go. Okay, thank you so much for joining me. We're just getting started. I'm Mitch Goldberg. You're watching my live stream. Be the boss of your money. We already have a comment out there, and I want to say thank you, Jerry. Happy birthday, Mitch. That's right. That's right. It was my birthday, Saturday, 55. So someone said to me, double nickels. Someone said to me 55. That means you're a perfect 10. 5 plus 5 is 10. So it's a perfect 10. So thank you very much, Jerry. And thank you for your posts on Facebook and everywhere else. And I look forward to seeing you very soon, buddy. And we've got a few peeps out there right now. Jerry, Tina is out there. Hey, Tina, TLM. It was so great to meet you for the first time on Friday. You are truly a warm, wonderful person. And Michael is out there. Hey, Michael, good to see you, man. I appreciate you joining me. So let's break it down for you. Okay, I've got a couple of screens that I'm going to be showing you momentarily. But to put things in perspective, stocks tanked. They've been tanking. Last week was the worst week of the year so far, and if today's any indication, we're going to be seeing that at the end of this week, that it was the worst week so far. It's capitulation. Let's talk about capitulation. That's like such a big buzzword now. Capitulation. I've been hearing people talk about capitulation for so many months now. I'm kind of sick of it. It's like when people say, oh, this could be capitulation, this is a sign of capitulation. People like to say that. It's like saying the CEO of a major investment brokerage firm said today that he said on CNBC, he sees risk 50-50 risk of inflation. I'm like, that means nothing. So if we go into a recession, I told you so. If we don't go into a recession, I told you so. Just listen to me. We're in the recession already. Okay. Things we talked about, rapid, huge jump in the amount of credit card applications, Jobless claims up, job openings down, housing sales grinding to a virtual, literal halt. And, we need housing sales because every time somebody buys a house, that, think about all the spending that goes on when somebody buys a house, from carpet to appliances to paint. That's a big part of the economy. So the housing market is just dried up. You can't buy cars. I mean, it's not that people don't want to buy cars. It's just that you can't get your hands on a car. But I have one car. The lease is up, I think, this summer, August or September. The lease is up. And I'm like, I might keep the car because my kids are going to start driving soon. And, where am I going to get them a car? I mean, used cars are a fortune, and the price to buy the car at the end of the lease is so cheap compared to what the value of the car is. And the car has, like, in almost 3 years, I think I have maybe 12,000 miles on it. It's like, I think I'll just keep the car. What do you think? You guys giving up your cars after the lease, or you just buying the car outright for the agreed upon price, thinking that it's a better deal? Or you selling the lease? Are you selling, say to the dealership, hey, you want the lease, the car back? Give me some money and I'll give you the car back. Or maybe you call in Carvana and asking them. Okay, so let's move on. We had a really tough day in the market today. No sugarcoating it. We talked about tough days coming, and I've said in the show, I'm not just I said this and I said that, but we need a little backtrack, and I have to make sure that I have the credibility to sit here and teach you and to talk to you every day about this stuff. Okay, so I said this is the part of the market a couple months ago where you have to get used to investing, knowing that your investments are going to go down in value. Now, I don't lose sleep personally for my investments. I've seen my investments go up and down so many times. I've been doing this for 32 years. They go up, they go down. Doesn't change the way I live. People ask me, "Oh, you must be getting so many calls. What are you doing? You must be going crazy with the phone calls from clients." And I said, "No, I'm not getting more calls. I don't get more calls in the market skyrockets. I don't get more calls in the market plunges. It's pretty steady." And that's how I think a good financial services practice should be. By the way, you should have people, ready for this. We talk about getting ready for bear markets, and this is why it's so important to check in with your risk tolerance, your time horizon. It's important to rebalance when your stocks get out of control. Listen, I'll tell you a little story here. Okay, I had a friend who's a client, and he decided he's doing so well on his own. Retired individual in Florida. Well, we're still friends, but he's doing so well on his own. He's like, I don't need to pay anybody. I don't need a financial advisor. I'm up 80%. All these winners, and he's telling me the stocks, and I'm like, you've been through this before, man. You went through this in 2000. You went through this in 08, and he must be getting just absolutely crushed in the stuff, the meme stocks, the SPACs. I mean, good quality companies are getting smashed right now. So if you're not a good quality company, you get smashed and you probably don't recover. And how do you recover in this market? If you're in a stock that went up because it was a pandemic, because it's what attracted people to the stock, because you extrapolated the business like, a DoorDash or DocuSign and said, people will love this company because look how great it is. It helps us stay at home and work from home. Well, those days are over. So why the thesis for the stock is over? I just don't. People don't know how to walk away from a good party, I guess. Andrew, we're talking about cars. Andrew, I bought mine out. Okay, you bought yours. Wendy says, buy the car off your lease. I totally agree with that. And Menley says, I say keep the car too. It's getting pretty unanimous out there to keep the car. It used to be that if you went way over the miles in the car and you owed so much money on the car that you were better off just buying the car after the lease. And today we're like, we all have under mileage and we realize that we're still better off buying the car after the lease. Okay, so the jury has spoken. Thank you very much, guys. And speaking of jury, I want to point you to a poll I put out, okay? Point you to this. All right. Let me pop myself up here. I put a poll out today on LinkedIn, and why on LinkedIn? Because that's where um, you are able to put polls up. Can you put a poll on Facebook or Instagram? I am not really sure, but here's what I wrote: soothing or panic. If the Federal Reserve raises short-term rates by 75 basis points or more on Wednesday, this coming Wednesday, June 15th, how will investors interpret it? Will it be soothing for the market, meaning get the high rate increases over with and tamp down inflation? Or will it indicate that the Federal Reserve is in panic mode and the markets go lower? I've only had 35 votes so far. I'll refresh this page. Any more votes come in? 35 votes, but 71% of those who voted say the markets go down if the Fed raises more than 50 basis points, and sues the markets for only 29% of you are going with that. So I'll keep you posted. I've got a couple of other things. I'm a LinkedIn guy. That's my thing. And there I am right now, like watching myself. Okay. And I was quoted today in CNBC.com. So let me get that over. So that's the quote: if you save and invest the money first, before you spend the rest of your paycheck, your odds of becoming an investor and accumulating a net worth goes up substantially, said Goldberg. And I had another thing on this also on LinkedIn. I want to show you a little graphic I made. I make my pictures. You know me and my cardboard signs. I'm going on the wrong page. Cardboard signs. I get a kick out of making my artwork. Okay, but I put this here: the heat map, S&P 500. Me with one of my cardboard signs. This is me on Route 110 in Melville, New York, across from the Uncle Giuseppe Shopping Center, by the new restaurants that just opened up, holding this up. Heat map, S&P 500. And the reason is because well, let me get you. I'm sorry if I'm scrolling too fast. Right, every single stock in the S&P 500 is down right now. Yeah, so earlier today, every single stock in the S&P 500 was down. Every single one of them. Like, that's called indiscriminate selling. And so people are saying, hey, this means it's a sign of capitulation. I don't think people really know, and I think people are desperate for capitulation, for stocks to finally stop going down and go back up. I think people start to predict what they want. Like, they say, oh, no, I think this is going to happen. I predict things can't go any lower. Is that what are you basing your prediction on? Based on, aside from that, it's your emotions and it's just what you want. All right, so let's talk more about the day. The day was a tough day. It started out tough. Futures were down last night. Selling continued from Friday into Asia and Europe, hit our shores with the selling. Market was down about 700 points. Later on, it was only down about 500. Then, it seemed like we were going to recover. And the last half hour of the day, the market just plunged into the close, down almost 1,000 points. All the major benchmarks were down a lot. And stocks were just gapping down 5, 8, 10% down. And I'm talking quality, big names out there. Okay. So that's what I see. A couple more comments. Jay says, instead of buying the car, ride a bike. Easy for you to say, man, you live in the city, but when you're on Long Island, if you don't have a car, you got nothing, right? It must be an open end lease, I think. Okay. I don't know anyone who gets open end leases anymore. I mean, open and lease, I always thought that was for people who couldn't get a closed end lease. We'll have to talk more about that next time I see you. TLM, I purchased my car and I'm keeping it. We got a lot of keepers. CNBC is in full panic mode. I'm going to say, yeah, panic mode for sure. Listen, bad news sells. Showing video of a train wreck is something that people watch, right? What's that? Dirty laundry? Never mind my comment. Oops. Okay, there we go. Thank you, Jerry, for clearing that up. Jay says, LOL. Okay. Yeah, that's like a whole topic about buying a car after the lease comes off, because in today's day and age, when used to be you would never do that. Why would you ever want to own a car that comes off a lease, right? So who's keep calling me here? Oh, I got to take that in a minute. All right. So these are the things that are going on. Um, let's take it to the big board. Okay, I have to send a text real quick. Okay, just don't spare with me a second. I know what you're thinking. This is like crazy that I'm doing this. Hold on, Doug. I can't talk right now. Can I call you back? All right, I'll call you right back. I'm doing my live stream this second. Okay, but I'm available to you. All right, I'm around. Yes. Okay, I'm ready. You got it. Thank you, buddy. Bye. All right. News 12 is coming to my office in about 15 minutes. So that's really cool. That was the call there. Sorry about that, guys. I mean, I have to take these calls when these opportunities come up, and I really appreciate it, News 12. Thank you. So let's take a look. Dow down 876. Remember, it was down over 600 on Thursday, down 850 on Friday, so down 876 today. These are substantial daily hits. I mean, you're talking about an 8-9% drop in the Dow in a couple of days. Nasdaq down almost 5%. There is no love for tech stocks. I mean, the Nasdaq is down over 500 points. These are huge drops. The S&P down 151, down 4%. Gold even was down. Gold should have been up. Okay, oil was up a little bit. The 10-year, we're going to talk about bonds. So I think that's the most important thing we're going to talk about today. And the VIX way up over 22%, up to 34. So we are so far away from that magic number of 20 or below that it's not even worth talking about right now. So we're not going to get into it. Ooh, Karen, I see you out there. Thank you so much. Attorney Karen Tenenbaum is out there. Thank you. And that means a lot. Thank you so much for joining me. I got your message, meeting Kelly, and I will get back to you. She is terrific, by the way. I'm really glad. I'm really glad we finally had a chance to meet in person. And while we're out there, top-notch client service. Absolutely. Hey, Zach. Or media response. Yes. Media. I actually wasn't exactly sure what you're talking about. Yes. Quick media response. Top-notch client service. I actually put my desk. I have two desk phones. I actually put them on privacy mode when I start the live stream. So, but I do give good top-notch client service, Zach. So thank you very much, as I know you do as well. And so let's keep going. Let's take a look at the bond market, because I think this is where the sell-off started to happen. If you recall, the sell-off started to happen right after Thanksgiving last year. The Dow had like 1,000-point day, and ever since then we've had this volatility. This has been going on for over 6 months now. It's been going on for like 8 months. All right, but let's take a look at yields. The 2-year Treasury yield went up 0.32% to 3.69%. Please listen to me on this, okay? To see the 2-year yield go up 0.32% in a day, that is huge. That's a lot. We very rarely see days like that. I don't remember seeing a day like that in 32 years. That is a huge move up in interest rates. Okay, and I want to look at the 10-year at 3.66. Basically, the 3.366 minus 3.65, the 2-year, okay, and the 10-year are almost even. So basically it's a flat yield curve. And earlier today, the yield curve inverted, meaning the 10-year yield was a little bit lower than the 2-year yield. Usually the longer term you go, the higher the yields are. So we hit an inverted yield curve again today. And that is a reliable predictor of recessions. Like I've been saying, I think we're in one already. So the yields went up, and that just crushed it. You remember I said to you, NASDAQ was just absolutely crushed today? Remember we looked at the NASDAQ down 4.68%. Okay. That's when interest rates go up, the NASDAQ gets hit the hardest, because stocks, any index with the highest valued stocks will typically go up the most. So that's exactly what we have here. This is just absolutely a really tough day. Now, before we get into anything, you know, someone said in the comments, uh, Slim Dog said, CNBC is in full panic mode. By the way, we got Josh is out there. Enjoy these end of the day live streams. Thank you, man. Hey, Josh, thank you, Mother of Mercy. Thank you so much, man. Enjoy these. I'm like leaving it up there just because just because I really appreciate the comment. Okay, and who's out there? Dan, the man. 3-month and 10-year spread is still wide. Yeah. Look, you know what, Dan? You're right. And we could look at different parts of the yield curve and come up with different narratives. Absolutely. You know what they say? If you tickle, if you torture the data enough, it'll confess to anything, right? So we could like look at this and that and come up with different narratives. Let's not panic. Don't freak out. You know, I work in an office with, let's say, about 20 people, and some of them are worried. These are not financial advisors, by the way. These are attorneys. And they're like, oh, the market, and what about this? Right now, it's just people are afraid. Market makers, specialists in the New York Stock Exchange, they pull away, they back off, they see stocks coming in. So stocks have a tendency to gap down pretty hard. Instead of down a nickel or 10 cents, they're down, $3, $4 at a time sometimes. It's what's happening now. Nothing's broken as far as we could tell in terms of liquidity of the market or the functioning of the market or the economy. It's just we're getting used to higher rates. The stock market is deteriorating very quickly. I don't think the real economy is deteriorating down 5% in one day. It's deteriorating quickly because of inflation, but not as quick as the stock market goes. The stock market is typically moving much more magnified way than the overall U.S. economy on a day-to-day basis. Another reason why stocks are down, this narrative that the consumer is still in good shape and came into this in good shape. No, I don't think the consumer is in such good shape, even if you think consumers have cash in the books from all the stimmy money they got. I don't think that's the case. I think that they're losing all their money to inflation, and if they do have any money, they're holding on to it because they want to spend as little as possible to conserve their cash. And the retail numbers have been holding up because consumers are spending the same amount of money. It doesn't tell the whole story because consumers are buying fewer things with that money. So unit volumes go down. That hurts companies. It's called demand destruction. Okay. Oh, by the way, Dan, not disagreeing about the recession, though. Yeah, hey, listen. Hopefully we're wrong, though. I mean, but either way, when you invest with keeping in mind that recessions happen, bear markets happen, and every bear market recession that we have is the worst one ever, and we'll never be able to get out of it. And every one of them, we get out of them. If we're in individual stocks, the pandemic stocks or the meme stocks, I'm not confident about seeing those recover, but that's my opinion. But it's not my thing anyway. So we'll talk a little bit more about that some other time. And let's take a look at crypto. Today, the nickname for today is Crypto Crash Monday. So Bitcoin was down 15%, down over $4,000 today. That's a really big freaking move. If we had a 15% down day in the stock market in one day, that would be Black Monday, right? We would have had Black Monday. So I don't know if you'd say this is Black Monday for Bitcoin because Bitcoin typically, crypto is typically much more volatile than stocks. And Bitcoin went out at $23,000 and change. It was in the 22,000s earlier today, but as goes Bitcoin, as goes the rest of the crypto space. Let's check out the Dogecoin, the one that Elon Musk said he's buying and got people all worked up on and into, and that people actually bought because of him. I'm still pissed off about that. Where is Doge? Did I pass it? Maybe they took it down. Oh, there it is. Doge down to 6 cents. Remember, that was up to like 77 cents at one point. 77. It's like a $77 stock going to 6. Same math, right? So today was a tough day for crypto. What does that mean, a tough day for crypto? It just means that it's an indication that risk is coming out of the market. Nobody wants to buy anything. Nobody trusts the rallies anymore. Nobody wants to buy the dips anymore. It's a sea change in psychology. It's pretty bad. My own opinion is things get worse before they get better. You want to know how much worse? It's tough to say. The average recession goes down about 30%. So we're, mostly there, but it's a grueling experience getting out of a bear market and recession. All right. It's grueling to get out of a bear market because there are so many head fakes. And every time the market goes up, you think, this is it. I'm going to buy. So I'm going to put out a post like things that your future self will thank you for. Like your future self will thank you for exercising today, for owning a dog today, for telling someone you love them today, and for continuing to dollar cost average into your retirement plan through a down market. These are the things that your future self will thank you for. So don't stop investing. Okay. We will get through this. So ultimately, the stock market came down today for the same reason it was down last Thursday and Friday. Inflation is up so much and it is so pervasive and it looks like it's going higher. Like this whole peak inflation thing that's out the window. Inflation is so bad that now the Federal Reserve has carte blanche to do whatever it takes to tamp down inflation and just jack up rates. Because right now, if the people are worried or the Fed is worried that it could tip the U.S. economy into a recession, so the Fed wants to slow down demand just enough to bring down inflation, but not too much to go into a recession. That ship has sailed. We're in a recession. My opinion, we're in a recession. So the Fed doesn't even have to worry about that now. All it has to do is worry about inflation. So the Fed has carte blanche to just jack up interest rates and just crush everything and crush demand. And that's why you're seeing stocks go down so much, especially the economically sensitive stocks. Okay. Sector ETFs. Consumer staples was the best performing space of the day. Consumer staples, they make things we need like toilet paper or toothpaste. Procter & Gamble is like the ultimate example of a consumer staples company. Financials were down because interest rates were up, but financials were still down because the spread between short-term and long-term rates is too small for banks to really make money in their net interest margins. XLI's industrials were down. Healthcare was down. Building materials down. Technology down 4.43%. Utilities got rocked, which is an area that usually see hold up in a down market, or at least hold up better than relatively other sectors. Consumer discretionary getting rocked, communications getting rocked, real estate gets rocked, and energy was the worst performing sector of the day. So that's interesting. So let's take a look at some of the energy stocks. Because oil was up a little bit today. So if oil is up today, we spoke about this. If oil is up and energy stocks are down, well, it just goes to show you that there's no place to hide. So it's a really rough market. Cash is king. Now, if you want to invest, I'm not saying don't invest. This is a personal finance choice. But if you're a long-term investor, you invest. If you're gearing up for retirement or you have to set money aside for financial needs or you have the money set aside already, you wouldn't put that into the market no matter how much of a bargain you think stocks could be right now. Right now, nobody thinks stocks are a bargain, even though they're 20% lower than they were this past January. But that's how stocks go. When they're down, nobody wants them. When they're up, everybody wants them. All right. So that is almost it. See if there's any other comments that came in. Nope, that's about it. Guys, thank you so much for watching. I greatly appreciate your time. By the way, if you want to be a guest on my show, just let me know. I'm looking to have more guests. And I know that everybody who commented today would be a great guest to have. So if you want to join me on the show sometime, you just let me know. And one last one. John is out there. Hey, buddy. John, hi, man. It's nice to see you. Thank you very much, buddy. All right. And that's it. I got to get while the getting's good. And tomorrow's a new day. Keep the faith, guys. We will recover eventually. We'll be okay. All right. Go take care of your health. Take care, guys. Thanks.